In this video, we're going to cover traditional property investment strategies. Now, the reason we call them traditional, of course, is because they are the more traditionally viewed property investing methods and always include some form of transaction by way of a purchase. So at some point during a traditional property investment strategy, you are going to own that property. Now, the traditional methods include things such as buy-to-lets, it includes flips, it includes all the other various sort of HMOs and the buy, refurbish, refinance. And the considerations that you're going to have to think about for the traditional property investment strategies is that you're going to need a far larger amount of initial startup capital to get going. Now, don't worry, because this doesn't necessarily need to be your startup capital, but you are going to need to take into account all the transactional costs associated with a purchase. So those things might include the deposit. They're going to include mortgage arrangement fees. They're going to include solicitor fees. They're also going to include things such as stamp duty, surveyors and surveys. So as you can tell, the costs start to escalate quite quickly. Now, the beauty, of course, if you're going to do these on a consistent basis, you're going to do multiple numbers of these deals on a regular basis, you're going to be able to start reducing costs such as your surveying costs, your solicitor costs, because volume tends to bring discounts. So that's one way to bring costs down. Now, if you're doing this as a deal packager, then of course you're going to have even more transactions going through. You're actually going to be able to potentially charge the regular solicitor fee, save a little bit on a referral basis and get some of that back. So there are sort of different ways that you can offset the costs of the traditional property investment methods. Now, in terms of the pros, of course, the obvious pro is that you own that asset. So you have got no one else really to answer to. So for the period of time that you own that, whether it is short term in terms of a flip or whether it's longer term in terms of letting it out, you're going to benefit from whatever that capital appreciation is compared to the work that you've put into it. And of course, you're not going to have to share that with anyone else, unless of course you have joint venture finance, which is a totally different section of the course. So a great advantage, of course, is that, but the biggest disadvantage is the startup capital that you're going to need. It also tends to require a much harder negotiation in terms of the purchase price when it comes to traditional investment strategies. The saying goes in the property world that you make your money when you buy. And that generally comes into the discounts that are on offer. And of course, depending on what the market conditions are at the time of you trying to negotiate on property deals, you may well find that discounts are few and far between. And the discounts are actually what you're relying on, certainly from a buy, refurbish, refinance or a flip, because you get some money back on the discount, then you add value longer term, and then you refinance or you flip that for the profit in between. So there's a lot of considerations when it comes to the traditional method, but of course, if you're looking to build up your own portfolio, you're looking from the point of view of legacy, retirement planning, you're looking to the future to give yourself sort of a big nest egg, a big capital appreciation amount that you can get at the end of when you do decide to retire, or whether it's something legacy to pass on to your kids. You're going to probably want to own those assets to benefit from them the most. Now, of course, there are opportunities to control assets without actually owning them, which is the creative property investment strategies, which we will come on to in the next video.